Welcome back to Everything Futures, the Optimus Futures Podcast, where we break down the strategies, psychology, and tools you need to navigate the futures markets confidently. Today we're tackling a topic that every trader faces at some point, FOMO, the fear of missing out. We've all been there, watching a market make a big move, feeling the itch to jump in before it's too late. But here's the thing, FOMO doesn't have to derail your strategy. In fact, with the right approach, those moments of fear and anxiety can be turned into some of the better trading opportunities. Visit our site at www.optimusfutures.com. Our educational blog delivers valuable insights, and by registering your email, you'll receive essential market updates. In today's episode, we'll explore what FOMO really is, why it hits traders so hard, and most importantly, how to turn it into a calculated, disciplined advantage. We'll share actionable strategies to avoid impulsive decisions and ways to reframe FOMO into a mindset of preparation and patience. Whether you're new to trading or a seasoned pro, understanding and managing FOMO is essential to long-term success. So please stick with us as we unpack this critical topic and help you trade smarter, not harder. So let's dive into one of the most critical aspects of transforming FOMO into disciplined trading, and that is identifying your personal fear triggers. Every trader has them, but successful traders learn to recognize and manage them. Think about your last 3 impulsive trades. What was happening in the market? Maybe you saw a futures contract suddenly spike and jumped in without checking the news, or perhaps you watched others posting their gains on social media and felt left behind. These are classic fear triggers. One powerful exercise we recommend at Optimus Futures is keeping a trigger journal. When you feel that urge to trade impulsively, pause and write down 3 things. 1, the market condition. 2, your emotional state. And 3, your physical response. Are your palms sweaty? Is your heart racing? These physical cues are often your first warning signs. Common fear triggers include seeing multiple green or red candles in succession, breaking news alerts affecting your futures positions, trading chat rooms buzzing with excitement, end-of-day FOMO when you haven't taken any trades, and the opening bell rush. Now, the goal isn't to eliminate your trading triggers. This would be impossible. Instead, we should focus on developing a personal alert system. Recognizing your triggers should serve as a cue to pause and go through your trading checklist rather than an immediate signal to enter a trade. It's important to understand that self-awareness in trading is not solely about psychology. It's also about safeguarding your capital. Each trigger you identify represents a potential profit leak you can address and fix. Every trader knows that gut-wrenching feeling of watching a setup they identified run without them. Today, let's transform those missed trades from sources of frustration into powerful learning opportunities. First, let's normalize something. The perfect trade entry does not exist. Even the most successful traders typically catch, in our opinion, just the middle 60% of a move. That's why we developed the 15-minute reset rule. When you miss a trade, set a 15-minute timer. During this time, you'll do 2 things. Analyze why you missed it and identify the following potential setup. Here's the systematic approach. Take a screenshot of the missed trade. Mark your intended entry, stop loss, and target. Now, crucially, identify which of the 3 main miss categories it falls into. Hesitation, meaning you saw it but didn't take it. Preparation, you weren't ready when it happened. Or process, you saw it too late. The recovery comes from immediate action. If it was hesitation, review your last 3 similar successful trades to rebuild confidence. For preparation misses, adjust your scanner or alerts. For process misses, determine if there's a second entry opportunity using pullback levels. The key is transforming regret into a routine. Each missed trade becomes a brick in building your trading system. Remember, missing trades isn't the problem. How you respond to them determines your long-term success. Create a simple log. This would include date, setup type, miss category, and next action step. This transforms the emotional response into a systematic improvement process. Now let's talk about transforming your trading from reactive to systematic with a powerful trade validation checklist. Think of this as your pre-flight checklist. Pilots don't take off without one, and neither should traders. Your checklist must be short enough to be practical in real-time trading, but comprehensive enough to keep you out of trouble. We recommend the 5-point power check system. Before every trade, you'll verify these essential elements. First is market context. Is this trade aligned with the overall market direction? Are we trading with or against the trend? Major indexes should confirm your direction. Second, technical confluence. You need at least 3 technical factors aligning. This could be support and resistance, moving averages, and volume patterns all telling the same story. One indicator alone isn't enough. Third, your risk definition. Can you precisely identify your stop loss? If you can't clearly define your risk, it's not a valid trade. Your potential loss should be known before entry. Fourth is time frame alignment. Your trading time frame should show the same setup as at least one higher time frame. This prevents you from fighting larger trends. Fifth is position sizing. Based on your stop level, does this trade fit your risk management rules? Never compromise on position sizing, even with a perfect setup. The magic happens when this becomes automatic. Start by actually checking these points out loud. Yes, definitely talk to yourself. After about 100 trades, it becomes second nature. Building on our discussion of trade validation checklists, let's address how to recover when FOMO causes us to abandon those careful protocols. The key transition from validation to recovery starts with our trading timeout protocol. When you identify a FOMO-based loss, typically characterized by breaking multiple points from your validation checklist, immediately reduce your position size by 50%. This reduction serves as a bridge between your structured checklist and the path back to disciplined trading. The 3R rule becomes your new validation framework during recovery. Instead of just checking the 5 technical points we discussed, you'll need to achieve 3 successful risk-defined trades at your reduced size. Each trade must explicitly meet every point on your original validation checklist, no exceptions. Documentation becomes an extended part of your checklist process. For each FOMO trade, record which validation points you skipped and why. Was it the market context you ignored? Did you fail to check multiple time frames? This becomes your never again journal, a powerful addition to your validation system. Calculate your FOMO cost, not just the monetary loss, but also the opportunity cost of capital tied up in poor positions, the emotional capital spent, and recovery time. Add this calculation as a 6th point to your validation checklist during your recovery period. This systematic approach ensures that recovery isn't just about making back losses. It's about reinforcing and strengthening your validation process. Think of it as rebuilding your trading foundation one validated trade at a time. Now adding to the recovery system, let's explore how small wins create lasting patience. When rebuilding after FOMO-driven decisions, the focus shifts to what I call the small wins multiplication system. This approach starts with targeting just 1R trades, where your reward equals your initial risk. While this might seem underwhelming compared to those massive home runs you see posted online, it serves as a crucial psychological purpose. Each successful 1R trade reinforces your validation checklist and recovery protocols. As you stack these small wins, gradually increase your targets to 1.5R, then 2R. This measured progression builds your patience bank. Each small win deposits confidence in your ability to wait for proper setups. The key is celebrating these modest victories appropriately. Document each successful trade where patience played a role. Was it waiting for the pullback instead of chasing? Did you hold through minor price fluctuations? These become your evidence of growing trading maturity. Implement the 3 green rule. After 3 consecutive profitable trades, regardless of size, allow yourself to increase position size slightly. This creates a sustainable growth pattern based on demonstrated patience rather than FOMO-driven swings. Throughout this episode, we've journeyed from identifying fear triggers to building a sustainable pattern of patient trading. Remember, transforming FOMO into discipline isn't about eliminating emotion. It's about building systems that work with your psychology, not against it. Your trade validation checklist, recovery protocols, and small wins strategy form a complete framework for consistent trading. The path from FOMO to disciplined trading is definitely not linear, but with these tools and techniques, you can handle the challenges ahead. Keep building that patience bank one small win at a time, and watch how it compounds into lasting trading success. Thank you for listening to Everything Futures by Optimus Futures. Trade futures at optimusfutures.com, where you can begin with micro futures for just $500. This material is a solicitation for derivatives trading. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The risk of loss in trading commodity interests can be substantial. You should, therefore, carefully consider whether such trading is suitable for you in light of your financial condition. The placement of contingent orders by you or broker or trading advisor, such as a stop loss or stop limit order, will not necessarily limit your losses to the intended amounts, since market conditions may make it impossible to execute such orders. The high degree of leverage often obtainable in commodity interest trading can work against you and for you. The use of leverage can lead to large losses as well as gains. Optimus Futures LLC is not affiliated with, nor does it endorse any trading system, methodologies, newsletter, or other similar service. We urge you to conduct your own due diligence.